Hello again. Today I'd like to talk to you about what's taking place in markets and my forecast for the upcoming future and how we're handling investment at this time. And I'd also like to announce a very special new opportunity for investors that we were unable to offer until we received some fantastic upgrades to our financial technology resources. As you know, the markets were very hot in January, and this is something that I'd like to explain in more clear terms. The money supply is the source of inflation. Essentially, when the federal government put out a tremendous amount of cash into the hands of the citizens and the companies in the country, the M2 money supply increased over 40% compared to the last couple of years. And that is a tremendous rise in the amount of cash in the system. And naturally, if you're thinking about companies, you know, how they see you walking in with a fistful of dollars and they're going to say, well, you know, the discounts are not available today. Prices have risen. And that's exactly what's taking place across the entire supply chain. Now, this isn't unique to the United States. It also happened in other countries. So this is essentially the core of inflation. And what happens is the Federal Reserve will come out and say, okay, we're going to raise the interest rates to try to slow down the economy. That certainly had an impact on real estate sales, and it's had an impact on real estate prices as well. Now, I'd like to talk about what happens with the Fed, because what happened in January was that many retail investors and what we call meme investors, which are people that are on places like Reddit and other resources, they tend to get all excited about certain stocks that are companies that are really not doing very well, like Bed Bath & Beyond or other companies that are close to bankruptcy, and then they bid up the prices of these stocks. And this happened with Tesla recently as a result of its considerable decline in value since Elon Musk took over Twitter, and so on. And so essentially what happens is that the Fed was expected to slow down their interest rate rising regimen, and that led to a tremendous amount of excitement on the part of meme investors and other people, which constitute a very, very highly concentrated group of people looking at particular stocks, especially technology. And as a result, the market rose about 7% or thereabouts. However, on Valentine's Day, the Fed announced a much more hawkish approach to interest rates, and they basically said inflation is not going to, it's showing that it's not subsiding, and therefore what took place is the market has been selling off since that time. Now, really, at this moment, there are considerable headwinds as we enter the second half of the first quarter of 2023. You don't need me to cite all of them. There are certainly many reasons why an investor should be careful at this point in time. One of those reasons is that there's so much volatility that in my over 30 years of being involved in investment management, I cannot look back at a time when there was this much volatility and this much difficulty for professional investors to be able to forecast accurately and say this is what's going to happen. And as a result, many very, very august firms that have great reputations over a long period of time are being very cautious, and they're sending out warnings and saying, look, this is not a great time to be a speculator. And so we are definitely not in the speculation department. That being said, the securities that we own and the sectors of the economy that we own are doing extremely well. And that being said, also, we're maintaining a high position in cash for most of our client accounts, especially because it is after last year, many investors would prefer to say, listen, I'd rather be safe than sorry at the moment. Therefore, as you know, you're more likely to not lose sleep as headwinds start rolling in and clouds start forming and storms run into and cold fronts come in and storms come after them. So at this time, we're taking a very conservative approach. We're saying, listen, this is a great time to be cautious. This is a great time to not lose sleep. And this is a great time to be careful and to choose very wisely and to minimize exposure to risk. And that's really where my head is at as a professional investor. Now, I'd like to talk to you a little bit about an announcement that we're making. As you know, many people who have 401k or 403b or thrift saving accounts are very frustrated because they really don't get any support at all from the institutions who are custodians of their retirement money. And also the human resources departments basically just give them pieces of paper. And what winds up with many of these situations is that people have a water cooler conversation with somebody who claims to understand investing, and they say, well, why don't you buy X, Y, and Z? Those are the best choices among the various choices in your list of possible options for investing your 401k money. Now that's really a big fail, and it's something that really has been on my mind for many years because I've had many clients who are participating in retirement plans who really don't have the support they need. Now, technically, the assets that are in these retirement plans are called held away assets in comparison to assets where we have a custodian who handles your account and your account is something that we can manage directly. Our technology has improved considerably, and now we have the ability to actually actively manage held away accounts. And what that means is that all an investor has to do who's in a 401k plan or another kind of retirement plan is literally give us an authorization to access their account, and then we actively manage the account for you and provide you with the recommendations we have based on our forecast and based on our investment philosophy. In many cases, people who received our investment recommendations associated to retirement plans actually didn't implement our recommendations because they got busy, and there was a game, there was something with the kids, someone got ill, you name it. There's all kinds of distractions that come up, and it's very hard for people to follow up on recommendations, especially involving assets that are held away. And so our ability to actually access the held away account directly with your permission gives us the ability to bring expertise to the table and help you. And actually the statistics show that there's approximately a 3% annual rise in return when a professional investment firm manages a retirement account for you in one of these held away situations. So this is something we're very excited to announce because it's been something that really needs to be available, and it is compliant. It has no problems with any kind of regulatory or other standards, and this is something that we're very excited to be able to offer for our clients and our clients' friends who are working for organizations that have retirement plan arrangements. So these are the things that we're looking at this point. Keep in mind that things are changing rapidly. It is a dynamic time, and our investment approach is a dynamic approach with our tracking approach, which involves over 49,000 ticker symbols, and we're looking for opportunities. And I will say that, as always, we want to be confident before we make a commitment. And at this point in time, confidence is not at a very high level for investment markets, and therefore we are making less commitment than we might normally make in a more optimistic environment. And thank you very much for taking the time to listen.